So we're talking about the commercial banking system in the US and its history and how we came from what it was into what it is today. And so I pulled out this origins of commercial banking in the US table and notice the first bank, the Bank of North America, was found in 1781 with a $400,000 of capital. I mean, compared to the $700 billion that we have for Chase or Bank of America today, these were the first, local banks, if you will. And after this initial bank, we actually had numerous banks that came about up until the 1800s, and um, and all of them were small. They were local, and some of them actually had their own money printed, and um, and they were all commercial banks as we understand it today. So they were not like any investment banks or credit unions, if you will. They were pretty much with the true meaning of commercial banks. And they've gone through significant change. In the 1800s, we actually had about 29 banks in the US and with an authorized capital of about $27 million. And through the years of the first part of the 1800s, it actually has gone up to 382 banks with a little over $200 million of paid-in capital. So, I mean, this is a significant progress. I mean, if you think about it, the National Banking Act was in 1863. And up until then, we had very close to 400 commercial banks operating in the United States. And so much so that, if you look at, say, 1900s, the number of banks actually reached at one point 13,446 commercial banks. And through, you know, through time, this actually got up a little higher than 14,000. And then in 2018, we're down to 4,774. And notice all of these banks are now either failed or consolidated, merged, or simply got acquired by others. But there's a significant change in the banking domain and in the commercial banking domain. And this change began with, the very origins of having just a few banks all around the US, up to a little over 14,000 different banks. And then, and now we're about one third of what it was in 1950s. Um, and so it is fascinating in the sense that the banking, the commercial banking has gone through such transformation, not just from regulatory point of view, but from entrepreneurship point of view as well. And they roll within the economy as well. In fact, if you look at the total bank loans and assets as a percentage of our GDP, we have a continuous increase. And how we talked about how the U.S. economy is more about the bond economy, and that we are not primarily a banking loan economy. However, about 40 to 45% of total assets and loans make up the percentage of our GDP. And notice how the assets are also about 80% of our GDP. And this has, significantly improved from 1950s up until the 2018. And this transformation again, notice how at the same time, when we went from 50% to 80% in assets, number of banks actually declined from 14,000 down to about 5,000 banks. So banks, overall, the commercial banks just got bigger, part of the economy, part of the financial system, yet the number of banks have reduced substantially. So whatever banks that we had, it actually looks like there's a lot more consolidation, and certain banks became bigger. And just as we discussed last week, the top 10 banks make up significant portion of our entire banking system. So now that having, you know, seen how the banking system became bigger as a system within the GDP, within our financial and economic system, and how the number of banks have declined consistently over the past 70 years, let's take a look at the largest banks in the US. And as we always picked on JP Morgan Chase, their total assets are about $3.4 trillion. And notice how this is by Federal Reserve system. So notice how their assets are, some of them are domestic and some of them are international. So through this reporting, consolidated reporting, we can actually see how much of those assets are domestic and how much of those um, are not. And we can also see the number of branches that they have and number of foreign branches as well. And notice how they have a different charter, national, SME, SMB, and so on and so forth. So we'll talk about those a little bit later this week, um, because the Federal Reserve Act of 1913 created the Federal Reserve System. And immediately after, in 1933, we have a Banking Act, Glass-Steagall Act, that defined the FDIC, along with it, the definitions of what is a local bank, what's a national bank, and what are the requirements of these different types of commercial banks. So when you look at JP Morgan Chase, notice how they have about 78% of their assets in the US. That leaves them with 22% international, and they do have about 32 branches foreign. So why would a bank have foreign branches? I mean, again, from a commercial perspective, commercial banking perspective, having a bank that operates over state lines makes sense. You want to be a national bank. Um, the bigger the bank, more deposits you can collect, more profitable you can become, and you could actually lower the overhead costs of a bank and expand it over about close to 5,000 branches, and you could create a system in which your capital can also be extended to whatever the 5,000 branches can contribute to your assets and liability structure. However, why would a bank want to have a foreign branch? I mean, if you think about it, it's a different country, different risk, political risk, economic risk, market risk, financial risk, foreign currency risk, and it also obviously creates opportunities, and it provides banks with access to money systems, financial systems of those countries. However, it usually is the other way around. When I say money systems, the money markets, it's a lot more common for a foreign bank to have an operation in the US just so that they could participate into our money market and our financial system. It also provides banks with that international security image of having a US presence. A bank from, say, like Deutsche Bank from Germany, having a branch or an actual bank in the US provides them with access to US financial system, US money market, and US clients who may have high net worth or higher net worth than the ones that they have access in Germany or in Europe. So it is usually the other way around, that you actually have smaller countries having access to the US market, where the commercial banking is significantly bigger and the funds are little bit more larger, and therefore, um, it's more for these foreign banks more desirable to be in the US. But why would a US bank want to be in a foreign country? And again, um, a lot of the times it provides the banks with that international diversification. It provides services to their clients. And many of these banks are trying to cater to high net worth individuals through their wealth management. And as part of that wealth management, sometimes you have clients who live in multiple countries and they require that multiple um, country services. It also allows these banks to undertake international trade operations, international trade financing, letter of credits, letter of guarantees, syndicated loans, and also provide the platforms for these banks to offer, um, lending opportunities to larger corporations outside of the U.S. However, obviously, when it comes to Citibank, I'm having a hard time explaining 122 branches. But then again, Citibank is a little bit more into retail banking and more wealth management, and I'm sure that you've noticed that their credit card operations are significantly more competitive than similarly sized banks within that top 10 list. So the 122 countries or foreign branches, um, maybe because they want to operate a little bit more. Oops, all right, a little bit more into that international retail banking sector. I mean, from my own experience, I know that Citibank exists in Turkey, or at least existed when I was in Turkey. But we didn't have a JP Morgan Chase. We didn't have a Bank of America, but they actually have branches in Europe. But Citibank did have branches in Turkey, and it was an actual operating bank. Um, but like I said, they are a little bit more into retail, and that retail aspect might actually become more of a desire to expand internationally. But notice how different banks have different strategies. This is what we have been talking about. Not every bank is into having 5,000 branches. I mean, look at this. Goldman Sachs, which actually has approximately $500 billion, $500 billion of consolidated assets, only have two domestic branches because they are not into retail banking. And even though they have significant funds, they are not an actual, let me open a branch and let me get into, uh, checking accounts or savings accounts or mortgage transactions, car financing for retail customers. Recently, we've heard that Goldman Sachs was trying to, um, you know, work with Apple to provide credit card services to Apple clients, which to me was quite interesting because that's not something Goldman Sachs does. Um, Ordinarily, I would have expected more of, say, Citibank or Wells Fargo to undertake such ambitious uh, plans, but evidently, I'm sure they know better. So, and notice, by the way, that while we're looking at, all the largest banks in the US, um, the top, say, I want to say top four are the ones that have more than $1 trillion in assets. And just last week, we looked at how, just top two, the JP Morgan Chase and Bank of America makes up a significant portion of U.S. banking system. Even though it is going from this many banks to this many banks, we are actually a lot more um, concise with respect to national banks than as it appears to have 5,000 banks. We might have 5,000 banks, but majority of the funds are actually under the management of a handful of banks in the US. So, we have the JP Morgan Chase, Bank of America, Citibank, and Wells Fargo. And then, the other ones, I guess, one that we would know better would be Capital One. They've got $500 billion. Citizens Bank, I'm sure that many of you know. And the others are not as uh, common to us. Morgan Stanley, obviously, but the State Street, we have alumni working there, but I didn't realize that they were actually an active uh, commercial bank. And again, you could see why, because State Street only has two branches, domestic branches. So I guess the banks that we know as commercial banks, from the meaning of retail service, I'm kind of looking at the banks that have large uh, bank branch network, and not just their assets on the management, but that branch network. So when I say, like, we know the Capital One or the Citizens Bank, then you're looking at, Wells Fargo having about 4,500 branches, and then US Bank having about 2,300 branches, PNC Bank having um, 2,400 branches. And then I'm not sure what I know this one, but this one, Trust Bank having 2,000 branches, and Capital One having 283 branches. That's a bit low, in my opinion. I would have expected them to have higher. But anyhow, so, and notice how some of these banks are almost exclusively US. Um, Goldman Sachs 87%, but Capital 100%, and most of them are all 100%. And as we get smaller and smaller, notice how almost all the banks, Hancock Whitney, 100%. I mean, these are all 100, almost 100% domestic banks. And, this again is kind of makes more sense that from the perspective of you would actually see more foreign banks operating in the US rather than the US banks operating internationally. So this is sort of an evidence to that effect. So we talked about how the banks, just number of banks have went from 14,000 down to 5,000. And here's a little table that shows the bank failures that we had within the recent history. And this actually shows how the failures as a percentage of the number of banks that we have operating in the US. And notice for every decade, we have about 28, 40, 78. And in 1980 and 1989, we have about 1,100 banks that actually failed. That's 8% of the entire banking system failing and requiring the assistance of the FDIC. And remember, the FDIC was established in 1933. And, about 50 years after, with the full fate of the US government, being able to handle 1,100 banking failures is quite impressive. And then the following decades, we still have 3-digit banking failures. And even for the past decade, we have 312 banks that actually failed. And, that's about 5.6% of all the banks that we have in the US. So it is not per se the banks are filing for bankruptcies. In fact, many of these banks are mergers and acquisitions, and the banks simply just not having the required capital adequacy ratios, not having the required liquidity ratios, not performing well, and they're not allowed to fail, and therefore FDIC merging multiple banks sometime. So, we talked about how the First Republic or the BAML failed miserably, and they were like the biggest examples that we have seen in the recent commercial banking history in the US. So not all of these are as disastrous. However, there are obviously a few. But even so, this actually shows how there's a significant ongoing consolidation in the commercial banks in the US. So one of the recent banking disasters that we witnessed was the Silicon Valley Bank. And The issue, and I wonder if it is right here. So let's do it first. So, I mean, the Silicon Valley Bank is not in this list, but nevertheless, the idea is that when these commercial banks, one of the reasons that they fail is because their credit portfolio becomes risky. And, you know, a remedy to this is having these banks increase the amount of commercial paper or government paper in their credit portfolio. So I would have expected that through the years, we should actually see more US Treasuries uh, to be included into bank asset portfolios. And when I saw this, it was actually quite interesting because in 1950s, the 35% of total assets on average for commercial banks were treasury securities. Um, and through the years, this actually is now less than 5%, which kind of corresponds with the reserve requirements for these banks. And the I guess what surprises me in this aspect is that this actually shows how the banking system became more and more competitive. That the treasury securities do not pay all that much. It is more of a conservative investment for commercial banks. It is more of a for commercial banks to balance out or diversify their credit portfolio and therefore accept lower yields from these instruments. Whereas because of the competition, as they become less and less able to do so. And I think that the number of banks have been declining simply because of this increased competition in commercial banking, especially in retail banking, increased costs, and obviously the financial crises that we went through over the past few years, um, simply in like 2007 and 2008, where we had to have significant liquidity crunch and therefore have many banks fail. So, as part of this competition, the banks start to provide um, financial engineering products. And one of these products, which we're going to talk during this week, um, is the mortgages, especially variable rate mortgages and mortgage backed securities, which led to this 2007 and 2008 financial crisis. And it is, these types of financial engineering products that make the um, or that create opportunities for the banks, but that also create significant competition. And smaller banks, regional banks, may not be equipped to compete with the larger national banks to cope with the technological advances in banking and to undertake necessary investments into their technology, into their advancement in financial engineering, and therefore just can't cope. And that might actually explain why some of these banks have to simply give up um, and consolidate or accept to be acquired or merge with the national banks. But again, the one of the issues of having these local banks is they act like a like a subcontractor to collect deposits, to do the footwork for larger national banks for the branch network that they do not have in certain parts of the country, having the local knowledge, having the local access, having local management might actually provide these banks with a very important competitive edge, but only as deposit collecting institutions or credit giving institutions. From a national bank perspective, if you want to have access to these local markets, it just may not be profitable for you the amount of deposit that you can expect to raise may not be enough to justify a new branch. The amount of credit that you expect to pay out may not be enough to justify a branch, and therefore you might simply make arrangements to work with the local banks, smaller local banks, and to lend to them or borrow from them, and therefore cooperate in a financial sense. However, from a local perspective, this is not enough to compete with national banks, and I think that we are seeing how these banks are disappearing. So one of the issues that we progressed through the years is the safety and security of commercial banks, especially for deposit holders. And we discussed about the capital adequacy and asset liability and liquidity management. And one of the regulators in this sense is the FDIC. And even though FDIC is not a regulator per se, um, it provides a very valuable service for commercial banks to basically attract deposit holders to their institution, even though they may not be as reputable as a national bank. Simply saying that your deposits are insured by FDIC might be enough to appeal to a local clientele to open a checking account or a savings account with them and to bring some of their money to work with a local bank. Without this guarantee, smaller banks may not be able to have any competitive edge against the national banks and the size of these banks. I mean, how could a few $1 million local bank right here in Mandeville can compete with a $3.4 trillion Chase? So the FDIC provides guarantees for retail clients up to a certain limit. And this is actually per client, not per account. And you can see a little table right here that this limit has changed in 2008 dollars from about $70,000 up to $250,000. And this $250,000 was instituted after the financial crisis that we had, which again, we're going to talk about this AIC crisis later next week, where the banks literally had to depend on insurance industry to provide securitization for variable rate mortgages. And once the AIC failed, the entire system collapsed. And that shook the confidence in commercial banks, and people started to question whether they should leave their money at smaller, more local banks. And we have seen the largest number of small bank failures within that time. And one of the remedies to this by FDIC was to increase the FDIC limit to reestablish that confidence in local banks. So the money was simply moving from local banks, smaller banks, to larger national banks and making them even bigger. And we've first been introduced with the too big to fail back then. But, with the higher FDIC limits, the FDIC was hoping that the smaller banks would not bleed as much of their deposits. And so at that time, it actually worked out well. And currently, it still is the new FDIC limit. So finally, we have a different business focus by commercial banks, and this has been changing over the past 70 years or past 100 years. Originally, we actually had significant demand deposits that made up the liabilities for banks, and this number had been decreasing. In fact, back in the day, we used to have time deposits a little bit more than the savings or The CDs were a substantial part of these institutions, and more recently, we're more about retail banking providing services through debit cards, through credit cards, through electronic banking or digital currency, and and as such, the banking liability structure have changed significantly. So we also seen how the treasuries are losing their appeal within the bank's asset structure. But we also see that the real estate loans are increasing within the asset structure of banks. So this change obviously reflects how the banking focus, the commercial banking focus, had been shifting from more of a deposit collecting institutions and perhaps service providing institutions. And also they are becoming part of our, as Steve Jobs would say, our financial ecosystem, where one bank is now offering a checking service, savings account service, credit cards, debit cards, electronic banking, digital banking, international wire operations. It used to be that when you wanted to send money, you go to Western Union, and that was the only one that actually does international money transfers. Now you go to any bank, and they might actually have these arrangements that you can actually send money within the same day to any country in the world. So it's not just about deposit collecting anymore, but it's also service providing, and even the banks that were not as competitive in certain loan operations like retail real estate loans or car financing or credit card loans, you actually see now more national banks more active in these loans to retail. So even though it's costly, even though it's actually having them spend significant resources to cope and to compete with each other, there still seems to be the preferred business model for commercial banks. They are trying to integrate into everyday banking and financial services for individuals, for retail. And obviously, many of the banks also cater to high net worth individuals through wealth management and through other services. And we're going to talk about this, so I don't want to get into that right now, but how the banks also provide investment services and insurance services. And obviously, the banks themselves cannot provide these services. However, through holding companies, they have either affiliations or the companies that the holding company owns that they provide brokerage services, investment services. Nowadays, Chase, for instance, is offering a brokerage service that you can buy stocks, bonds, options, and it just, for a traditional commercial bank, this is not traditional business model. However, like I said, as the Steve Jobs would say, they're trying to create a financial ecosystem and trying to cater every financial need of an individual by offering retirement portfolios, credit cards, car financing, home financing, brokerage accounts, and every sort of need that a retail or a high net worth individual might need. So we have a huge transformation of commercial banking, all the way from a single bank in 1783, 1781, and all the way now to a reconstituted and significantly fewer, 14,000 down to 5,000 banks operating in a wider range of services and to provide a more reliable and more financially safe and secure and variety of services. So this week we will also talk about how the bank failures affected the banking system. We'll talk about the history of central banking, and then we'll talk about separation of banking and other financial services. and we'll talk about compare, the credit unions and different type of commercial banks, and and then this is basically, the week that we talk about commercial banking history, what makes them a significant part of our financial system, and how they're changing, and where it might be going. And this is also important for job applications that you might be considering, because you don't want to end up at a bank where it's obviously will be a dead end. So hopefully we'll also talk about some of the futuristic banking operations as financial technology companies, and going forward, we will talk about we already had a discussion about the blockchain and cryptocurrencies, but we'll also talk about how the internationalization of these commercial banks are helping to bring in the international competition for digital currency, for less regulation, and to provide wider services for individuals. So thank you for working with me, and please let me know if you have any questions, and I hope to see you guys soon. Thank you.